Financial markets were built on disagreement. AI is quietly ending that. Different analysts, different models, different assumptions, different judgments. That diversity acted like a shock absorber. When one group was wrong, another was often right. Today, the world's largest financial institutions are increasingly relying on the same intelligence, and the more they agree, the more dangerous the system may become. For decades, disagreement protected markets from collective mistakes. Now, artificial intelligence is quietly removing that disagreement. The question is, what happens when the institutions responsible for allocating trillions of dollars begin thinking the same way at the same time? As AI spread through finance, institutions that appeared independent began drawing conclusions from the same data, the same signals, and the same underlying models. In 2024 and 2025, three of the most influential financial oversight organizations in the world issued warnings about the same emerging risk. Not that AI would fail, that AI could make everyone fail together. History suggests why that matters. In May 2010, the Dow Jones lost nearly $1 trillion in value in 30 minutes as automated trading systems reacted to one another faster than humans could intervene. In 2012, Knight Capital lost $440 million in 45 minutes because of a software error. Not fraud, not a market collapse, a software error, running faster than any human could stop it. Those events involved relatively primitive systems. Today's systems are vastly more capable, but the deeper concern is not their power, it is their similarity. The machines are becoming smarter. At the same time, they are becoming more alike, and a financial system built on disagreement may be drifting toward agreement. To understand the depth of what is at stake, you need to understand what AI now does inside every major financial institution on Earth. JP Morgan has a tool called Socrates. It performs hours of junior analyst work in seconds, research, financial modeling, client preparation, before a single human opens their laptop in the morning. That is not efficiency. That is the permanent restructuring of what a finance career looks like. Trading. AI algorithms execute trades in fractions of a second, identifying price discrepancies and closing positions before a human analyst can read a single data point. Millions of market-moving decisions made by systems operating outside human observation. Credit decisions. AI models now make or heavily influence loan approvals, credit limits, and mortgage assessments at banks across the world, based on patterns the algorithm found in millions of previous decisions. Patterns that may include historical discrimination, perpetuated not because the AI was programmed to discriminate, but because it was trained to replicate the past. 85% of financial firms are actively applying AI in 2025. Citigroup estimated that 54% of financial jobs have the highest automation potential of any sector in the economy. The finance industry is not adopting AI cautiously. It is deploying it as fast as engineers can build it, and the consequences of that speed are only beginning to become visible. JP Morgan CEO Jamie Dimon addressed his shareholders directly. Artificial intelligence, he wrote, may reduce certain job categories or roles. He compared the impact to the printing press, the steam engine, electricity, the internet. The same year, JP Morgan, Goldman Sachs, and Morgan Stanley all announced layoffs. And yet, something unexpected appeared in the data. Overall headcount across banking and finance remained relatively stable. Bank of America employed just 4 fewer workers at the end of 2025 than it did in 2024. JP Morgan's headcount actually grew by 2,000. So which is it? 200,000 jobs being cut or headcount staying flat? The answer is both. Banks are not eliminating departments overnight. They are restructuring around a different hiring model. Fewer junior roles created, more senior roles maintained. The 200,000 jobs are not disappearing today. They are simply not being created tomorrow. The profession is not disappearing, but the apprenticeship is, and that may prove more consequential than the layoffs themselves. Marcus Chin graduated from Columbia Business School in 2024 with $200,000 in student debt and a junior analyst position at a mid-sized investment bank in Manhattan. His first week on the job, he discovered something unexpected. The financial models were already finished. The research summaries had already been generated. The client briefing materials were waiting for him each morning. The firm's AI systems completed most of the work before he arrived. His manager explained that his role was no longer to build the analysis. His role was to review it. There was only one problem. He had never learned how to produce the analysis himself. For generations, junior analysts learned finance by doing the work, building models, checking assumptions, making mistakes, understanding why decisions were made. The apprenticeship was slow, expensive, often miserable, but it produced judgment. Marcus belongs to the first generation entering finance after much of that apprenticeship began disappearing. He is being asked to supervise systems whose reasoning he did not create, using skills he has not yet had the opportunity to develop. Marcus Chen is not the real story. He is the first visible sign of a much larger transition. Every profession inherits wisdom from the people who came before it: pilots, surgeons, engineers, traders, analysts. The process is rarely efficient. It is slow, expensive, frustrating, but it transfers judgment, and judgment is what allows people to recognize when a model is wrong. The deeper question is not whether Marcus will succeed. The deeper question is whether the institutions of the future can preserve judgment after removing the process that once created it. At first, these looked like separate stories. A law firm using AI, a hospital deploying algorithms, a retailer automating customer service, a factory running without workers, a bank replacing judgment with machines. Different industries, different technologies, different consequences. But the deeper this investigation goes, the harder it becomes to ignore the pattern underneath all of them. Artificial intelligence rarely changes systems the way people expect. It changes incentives first, institutions second, society third. In finance, the incentive was simple: move faster, cut costs, outperform competitors. Institutions followed. Banks restructured hiring. Analysts disappeared. Credit decisions moved into black boxes. Risk models became increasingly automated. And now the consequences are beginning to emerge. Workers lose pathways into the profession. Borrowers are judged by systems they cannot question. Entire financial markets become dependent on models trained on the same historical data. What appears to be innovation may actually be synchronization. What appears to be diversification may actually be concentration. And what appears to be stability may be something far more dangerous. Because when millions of decisions are made by humans, mistakes are distributed. But when millions of decisions are made by systems trained on the same assumptions, mistakes become correlated. And correlated mistakes have a name: financial crises. For decades, financial stability depended on a simple assumption. If one institution was wrong, another institution would see something different. Different analysts, different models, different judgments, different mistakes. That diversity acted like a fire break. A bad decision inside one firm remained a bad decision inside one firm. But what happens when the world's largest financial institutions increasingly train their systems on similar historical data, optimize for similar objectives, and respond to similar market signals? What appears to be diversification may actually be concentration. Not concentration of ownership, concentration of judgment. The institutions still have different names. The buildings are still different. The logos are still different. But beneath the surface, the intelligence guiding decisions may be becoming increasingly similar. And if that is true, diversification itself may be slowly becoming an illusion. At this point, it is tempting to treat this as a future risk, a warning, a possibility, something that might happen if current trends continue. But that assumption contains its own problem, because the first stages may already be behind us. The question is no longer whether synchronized decision-making can destabilize financial systems. The question is whether we have already witnessed early versions of it and failed to recognize what we were seeing. In September 2022, the United Kingdom's financial system came within hours of collapse, not from fraud, not from a recession, from a model. Multiple pension funds across the UK were using similar liability-driven investment strategies, similar models, similar assumptions, similar responses to the same market signals. When UK gilt yields spiked unexpectedly, those models triggered similar selling simultaneously. The selling amplified the spike. The spike triggered more selling. The Bank of England was forced to intervene with an emergency bond purchase program, £65 billion, to prevent a cascade that regulators described as a genuine threat to UK financial stability. This is not a hypothetical. It is a documented, regulatory review demonstration of what happens when model similarity produces synchronized behavior at scale. The 2022 UK Gilt Crisis involved pension funds, not high-frequency trading algorithms. The AI systems of 2025 are faster, more widely deployed, and more deeply integrated into the financial system than anything that existed in 2022. The Federal Reserve's vice chair warned that AI-driven strategies could lead to herding behavior, potentially amplifying market volatility beyond anything the existing regulatory framework was designed to contain. And the most disturbing dimension of all, the AI systems running global financial markets are proprietary trade secrets. Regulators cannot examine the algorithms to understand how they will behave under stress. They can only watch and hope the next event is small enough to contain. The finance AI story is not a story about Wall Street. It is a story about everyone who depends on what Wall Street does. The mortgage that determines where your family lives, the loan that funds a small business, the pension that funds a retirement, the credit line that helps someone survive an emergency. Increasingly, those decisions begin with a recommendation from an AI system that cannot fully explain itself and cannot be appealed to a human being. The efficiency is real, the speed is real. The problem is, what happens when the patterns those systems learned were shaped by decades of discriminatory lending, perpetuated not by design, but because the system was trained to replicate the past. And the deeper problem is what happens when every system across the entire financial industry is learning from the same past at the same time. For decades, the diversity of human judgment acted as a buffer between individual mistakes and systemic failure. That buffer is becoming thinner. Not because anyone decided to remove it, because every institution followed the same incentive, and the incentive did not reward diversity, it rewarded speed. The flash crash lasted 30 minutes. Night capital lasted 45. The UK gilt crisis required central bank intervention to stop. Tomorrow's systems are faster, more interconnected, more similar, and more influential than anything that has come before. Somewhere inside global finance, millions of AI-driven decisions are being made right now, quietly, instantly, outside public view, outside regulatory examination. The next crisis may not begin with panic. It may begin with perfect confidence. And by the time anyone realizes the machines are wrong, the decision may already have been made. Financial markets survive disagreement. They fail from agreement. For generations, societies became stronger when different people saw the world differently. Different scientists, different doctors, different engineers, different investors, different institutions, different conclusions. Diversity of judgment was not a flaw in the system. It was one of the system's protections. But finance is not the only industry now being rebuilt around artificial intelligence. The same incentives are reshaping healthcare, education, law, media, national security, one industry at a time. Which leaves a larger question. If intelligence becomes increasingly powerful, increasingly accurate, and increasingly shared, what happens when every important system in society starts learning from the same intelligence? Because financial crises have always had a name for correlated mistakes. The question is whether society has won. Financial markets survive disagreement. They fail from agreement. Next on Disruption Files, the education industry, where artificial intelligence is already earning top grades at major universities. The work contained no original thinking, no learning, and $1.67 trillion in student debt may be funding credentials that can no longer certify what they were designed to certify.